to all of our podcast viewers and listeners, wherever you may be in this great world. I am Dave Springsteen, a CPA and tax leader at Withum and HLB International. Withum is a top-ranked tax advisory and accounting firm in the U.S. and, in fact, globally. Withum is a forward-thinking, technology-driven firm helping all of our clients in solving problems and putting them into a position of strength. I'm very fortunate today to be here with Mike Hurwitz, CPA, MST, tax partner in Withum's real estate group. He provides tax solutions from coast to coast to all of our clients. Today, Mike, with his coffee, is sharing his insights and experiences and thought leadership in real estate deferred exchanges, also known as 1031 exchanges, also known as like-kind exchanges, or better than a sliced bread solution. So, Mike, welcome. Great to have you here. I think the last podcast we talked about REITs. Here's another example, deferred exchanges, on how the real estate industry can benefit from the tax code. So, Mike, you want to say a word about yourself?
Just been in working for public accounting firms for the last 35 years, doing transactional tax advisory work, core compliance, and specializing in real estate. So, do a lot of work with like-kind exchanges or deferred exchanges, as you said.
All right, good. I see the coffee's kicked in. So let's start with the first question. What is a deferred exchange?
I knew you were going to ask that, Dave. So I did a little research last night. I went to the Webster Dictionary and I looked up what the word exchange is. And it says, I'll read it. I don't read too much. I ad-lib a lot. But it says the act of giving or taking one thing in return for another. The act or process of substituting one thing for another. And that's really what a deferred exchange, like-kind exchange is. It's really a very powerful strategy we use, or weapon we use, for tax minimization. And it allows a taxpayer to dispose of one or more properties or investments and acquire another one in a tax-deferred manner. So you're not paying taxes.
Good. Since you are the real estate guru, this doesn't apply to stocks and bonds. Does it apply to equipment? Just to clarify.
The Tax Cut and Jobs Act back in 2017 eliminated exchanges for machinery and equipment, vehicles, the bubblegum shrimp boat from Forrest Gump, artwork, collectibles. So now this code is only allowed for real estate assets. And that definition has been expanded. Real estate, now it applies to billboards, infrastructure, marinas, things that are permanently attached to the land, real estate.
I guess the clarity is, since most real estate is held by multi-member LLCs and partnerships, many taxpayers think they can just exchange their partnership units, their membership units. Is that true?
You can't do a like-kind exchange with a partnership interest or stock of a C corporation that may own real estate. It has to be the real estate itself. So the partnership could do like-kind exchange, or maybe individuals that own, or entities that own real estate in a TIC format, a tenancy in common, because there you're deemed to own the real estate directly.
All right. So the nitty-gritty, what are the benefits of doing a tax-deferred exchange?
Well, that's really the benefit. You hit it on the head. It's tax deferred. You're allowed to preserve your equity and really increase your purchasing power. So instead of selling something and having a gain and paying the tax and then reinvesting the net cash flow, you're allowed to reinvest all the proceeds without sacrificing cash for taxes. So to me, that's a huge benefit. The other benefit which I see is, it allows real estate professionals to kind of diversify and prune their assets without paying taxes. So you can diversify on a global level and redeploy all the money into bigger and better and larger scale assets. So those are probably the two main benefits.
And you talk about tax deferred, but at the end of the day, if you die with a piece of property that you've done one or multiple exchanges, you actually get a step up. So it could almost be a permanent tax savings.
Yeah, it can be. It can be a permanent, spot on, Dave. That's right. If you happen to own it, whether it's the interest in the partnership or however you own this real estate, and you do die, it goes into your estate. And, if you have a unified credit that can offset the tax, there would be no income tax. There may be estate tax, but there's no income tax. That is correct.
Very good. I like this idea. I like this planning solution.
It comes with some hurdles you have to get through. So
let's talk about the devil in the detail hurdles. What are some of the requirements of participating in a deferred exchange?
Well, there's three primary requirements. One, it has to be a reciprocal transfer. The other says it has to be like-kind property, and it's very broad, that definition. You can trade, exchange land for a commercial building. You could change hotel for a data center. It's very broad. It doesn't have to be the same type of property nor the same quality of property. It could be really any real estate for any real estate. And then the third would says it has to be for a business, used in a trade or business, or for investment purposes. So those are the three main requirements. Reciprocal transfer has to be like-kind property, and then used in business or held for investment purposes. There are some other requirements that kick in. Way back when, the first couple exchanges would be, I would exchange with you. Two parties would do a two-party exchange. I have a New York property, you have a Jersey property. We want to switch and exchange. But now, back in the 70s, there was a Starker case, and then in 84, they really changed the 1031 code section to allow non-simultaneous transactions, a three-party, a four-party exchange. So you have a QI involved, and you have some time frame and identification rules that you have to adhere to as well.
So a simple example, you own a piece of property worth $100,000. I own a piece of property worth $100,000. A deferred exchange, we could just simply swap properties. But in the real world, that doesn't happen.
That's right. We could swap, and originally it was really hard for a guy like me and a guy like you to find each other, to marry each other. So that's why the Starker case is a non-simultaneous transaction. I'm really selling to someone else and buying from someone else. And thus the use of, the 84 changes to the code came about for these non-simultaneous transactions. And what it now says is, I have a property I want to sell. I give the property to this qualified intermediary. It's a third party, and they're there to hold the proceeds. They're there to interface with the title company, the closing attorneys. They're really there to make sure I don't have constructive receipt of the money. So I sell my property through a qualified intermediary. Qualified intermediary goes out and buys new property from someone else. And that whole process, you have 180 days to do that in. And within that 180 days, you have a 45-day identification period. So to summarize and go back now, the transaction looks like, I want to sell my property. QI sells it. The QI, qualified intermediary, holds on to the money. I identify properties, replacement properties. QI goes out and buys the replacement property within 180 days, and I take the ownership of the new property, and that would be a good deferred exchange.
Yeah, it seems that the 45-day notification period, the 180-day closing period are very tight time frames, especially in this world of environmental issues, inspections, and approvals. Is there any practical advice that you can give a client that wants to sell a property, enter into a 1031, and meet these time requirements?
There's the time requirements are rigid. They're generally not expanded. Every once in a while, the president declares disaster zones, or with the pandemic, time sensitive actions, you're allowed to get extra time for it. But the best advice would be to plan ahead before you go and sell a property. Kind of have an idea of what you're going to buy, what you're going to use as replacement property. But the time frames are pretty rigid.
Very good. So, in your experience, Mike, are you seeing a lot more deferred exchanges happening? The real estate market seems to be very hot. And it's really a twofold question. Does this apply to personal residences too?
I see it mostly in the big landlords, the institutions, the family offices that have properties that want to maintain the management, the asset management, property management. I don't see it for people that are just looking to sell and get out of it. As far as individuals go, with their personal property, it can't be used for personal property, your apartments and things like that. I don't, as you know, I don't really do too many individuals, but they do use these to sell their rental homes, and they may go into a Delaware statutory trust. They may not sell and buy another rental property. They might buy a DST, which is a fractional share of a building as well, similar to a tenancy in common.
Very good. There's this term out there called boot. And there's a big no-no around this word boot. Can you just explain what boot is and why somebody shouldn't touch their boot?
So boot, I believe, is an old English term, if I'm not mistaken. It means give back or take back. I'll have to look that up. I'll post it on LinkedIn or something. But in a like kind exchange, the use of a qualified intermediary or an EAT exchange accommodator title holder, if you do a reverse exchange where you might sell property first and then buy one, you're not allowed to take money back. I mentioned earlier in the conversation constructive receipt. If you sell property and replace the property with something of lesser value or less cash, less mortgage, and you take back something, whether it's less debt, meaning you got kind of like a deemed distribution, or you take cash kind of off the table, you're deemed to be cutting ties with that original investment. And the government will then tax you to the extent you got boot back. The greater of the realized gain or the amount of boot you took back. So boot is, in the world of deferred exchanges, not a good thing, because then you're going to realize part of that recognized gain.
Right. So in this area of deferred exchanges, like-kind exchanges, IRC, 1031 exchanges, what can we do? What do we do for clients and prospective clients in this area?
Well, speaking about the boot we just had, the first thing is, one, we can help, and definitely with our clients, we have all their real estate, their details of the basis of the real estate. We can help them calculate the gains, obviously, and any state effects that may have. We can crunch the numbers on replacement property. If they're buying certain property, we can help them with the depreciation on the replacement property. So doing all the diligence for the acquisition, just getting involved in the transaction. And I think, a lot of times if we're involved early on, we'll be able to advise that they won't have that boot, and we'll make sure it's a good tax-deferred transaction and will be respected by the government. So,
right. At the end of the day, know before you go into a transaction, and you'll come out smelling like roses. So, Michael, thank you for your insight, your experiences in this arena. I do appreciate it. I know our real estate group is very robust in the solutions that we also provide. This is probably number 2 of a series of podcasts in the real estate industry that we can help any client on. So with that said, I thank you for your time, and we'll see you on the next podcast.
Thanks, David. I'll see you in a bit.
Yeah.